All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using a life insurance policy, you've come to the right place. So be sure to bookmark this page right now and come back and check out all my exciting content. All right, today I'm digging deep into the Double Play archives and resurrecting a video that I shot almost 2 years ago but haven't edited yet. So, what we're going to talk about today is why doesn't an IUL include dividends? The answer to that is actually quite simple. So if you want to get just the answer and not watch the rest of the video, stick around after the intro and I'll get started. But if you want to stick around, the point of today's video is going to be what is the mechanism by which IULs pay interest crediting and come up with their interest crediting? And what is a reasonable expectation of what kind of return you should expect with an IUL? So I'm going to answer that question of why an IUL doesn't include the dividends, as well as cover some of those basics. So stick around after the intro and I'll break it all down for you. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies. I came up with the concept of the double play many years ago on my own, and it's such a powerful concept that I really wanted to share it with the world through these videos in this channel. So the goal of this channel is to show you how you can put your money to work in two places at one time and earn a greater return by leveraging the cash value of a maximum overfunded life insurance policy to do what you were going to do anyway, investing in real estate. And along the way, we're going to debunk some of the myths and misconceptions about life insurance, which is what we're doing today. We're going to discuss a misconception about index universal life. So this is important because if you're researching life insurance and you come across these misconceptions or even agents who don't truly understand how life insurance works, they may get you to think that the performance of an IUL is going to match the performance of the index, and that's just not the case. So what I want to do with this presentation today is walk through the interest crediting process, what insurance companies do with the money, and how they credit the interest. And then we'll spend some time talking about what is a reasonable interest crediting expectation for an index universal life. All right, so let's take care of a little bit of housekeeping first. First off, there is no financial advice, no tax advice, no legal advice being offered in these presentations. This information is purely educational. And secondly, the purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, so let's talk about why IUL returns don't capture the dividends of the underlying indices and why it really doesn't matter. So if somebody is telling you that you should invest in whole life or you should invest in the market because the IUL returns don't include the dividend, that person clearly doesn't understand how life insurance works, because that's not the point, is to include the dividends. It's not even the point of an IUL to match the performance of an underlying index. The point of an IUL is to simply earn a premium over the debt market rate of return. So if you understand how insurance companies invest their money and how they credit dividends to the policy, the goal of an IUL is to simply credit more interest to the cash value than they would have paid as a dividend. So that's it. So what I want to do today is simply cover the basics of what I call Life Insurance 101. We're going to talk about what the cash value of a life insurance policy represents, and secondly, what the insurance company is doing with the money and how they're crediting the interest, so that you have an understanding of that. And then finally, we'll circle back and I'll show you some numbers. We'll do some playing around with data to figure out what is a reasonable return expectation for an index universal life. And then we'll wrap things up. So, all right, let's get started. All right, so this is a graph that you've seen in many of my videos so far, unless this is the first one that you're watching. But this is the graph of a minimally funded life insurance policy. And this is the kind of life insurance policy that most people buy. And when you hear somebody saying, oh, life insurance is a ripoff, don't buy it. Well, remember, people are buying life insurance for the death benefit protection. If you're buying a minimally funded life insurance policy or any typical life insurance policy thinking that the cash value is an investment, you're just mistaken, and you're making a big mistake, and you're not going to get the return on the money. And frankly, that kind of pollutes most people's minds against life insurance, or biases their minds against life insurance, when in fact a maximum overfunded policy is a completely different animal. But for the purposes of explaining what the cash value represents in a policy, it's easiest to do that starting with a minimally funded life insurance policy. So that's what I'm doing here. So I'm showing two lines on this graph. One is the death benefit and the other is the cash value. And you can see that the orange line represents the death benefit protection, and that's just set at $1 million. On the horizontal axis, you can see that this is a policy on a 45-year-old, and the blue line represents the cash value. And the cash value is quite literally the policy owner saving up the death benefit for the insured over the insured's life expectancy. It's pretty clear that the insurance company needs to collect enough in premium over the life of the insured to pay out the $1 million. So some of the premium must go into a savings account, essentially, to offset the $1 million over time. And that money doesn't sit idle. The insurance company is taking that money for part of the premium dollars, and they're investing it in primarily the debt markets. So treasuries, bonds, preferred stocks. I'll delve into the detail here in a minute. But as you can see, at age 45, at the very left end of this, there's a big gap between the death benefit and the amount of cash value at the very beginning of the policy. By the same token, if you go out to the end, like around age 113, you can see that the death benefit and the cash value bump into each other. So if the insured were to live that long, they would have essentially saved up all of their death benefit on their own. Now, that's great. Everybody can save up their own death benefit and self-insure, except that if you die when you're young, you don't have all the money that you're saving up for. So you're shifting that burden over to the insurance company. So during the early years, they're covering the gap. But over time, if you live to be your natural life expectancy, you would have saved it up anyway. And taking it one step further, if we look beyond age 113, you can see that the death benefit is getting pushed up by the growth of the cash value. And this is important to understand because you can see that you're not losing your money in any way, shape, matter, or form. Every penny that you've put into the policy either gave you death benefit protection, or in terms of the cash value, it's quite literally all of your savings is getting transferred at death to your beneficiary. Nothing's being held back or kept by the insurance company, which is another myth that the insurance company keeps the cash value. Cash value is quite literally part of the death benefit. It's just over time, the amount that the insurance company is at risk for is going down. So another important thing to take note of here is that if we look at age 79, you can see that roughly one half of the death benefit has already been accumulated in the cash value. So the insurance company only has about $500,000 of remaining obligations or risk to themselves. So yes, while you get older, the cost of insurance goes up each and every year because you get 1 year closer to your mortality. But by the same token, the amount at risk to the insurance company is going down. So in a properly designed policy, it's intended that between the premium and the growth of the cash value, that the cost of insurance covering that gap is always accounted for. So again, even in a minimally funded life insurance policy, the insurance company knows that if they achieve just a worst case rate of growth, that there will be more than enough money in that policy to cover the cost of insurance over the lifetime or life expectancy of the insured. So, one more thing that you can take note of here is that you can see that the insurance company has an incentive for the cash value to grow as quickly as possible. So the faster the cash value grows, the quicker it bumps into the death benefit and begins to push it up. By the same token, if they don't earn the required rate of return, then it would take longer to save up the death benefit and that policy might be at risk. But again, the guaranteed rates on policies are what form the pricing of the policy, and it's very unlikely that rates would drop that low. All right, so the next question becomes, what does the insurance company do with the money? So the insurance company invests very conservatively in the debt markets. And in a minute, I'll show you some reports from a couple of different companies' annual reports that show you exactly what they're investing in. Any increases net of the cost of the policy are credited as a dividend in the case of whole life policies. In the case of an indexed universal life, the insurance company takes the money that they would have otherwise paid to you as a dividend, and they go out to the index options markets and they hedge, trying to capture as much movement in the market as they can possibly get with the money that they have to spend. And when I say money that they have to spend, it's dependent upon the interest that's earned on the underlying debt portfolio. So if interest rates are down and they're not earning as much interest, then they don't have as much to spend on hedging activities. So again, the goal of an indexed universal life is to simply earn a premium over the amount they would have paid as a dividend. That's it. So it's not intended to match the performance of an underlying index, and it really doesn't matter if it includes the dividends or not. It's just the options are looking at the movement in the market only. So, all right, so let's take a look at some numbers. This is the invested assets for MassMutual from their 2020 annual report. And I literally just grabbed this online here to stick in this presentation. And you can see that bonds at the top represent about 53.5% of the total invested assets of MassMutual, followed by mortgage loans at about 12.2%, and then the remainder is spread across derivatives and other assets, common and preferred stocks, policy loans, partnerships and LLCs, cash and short-term notes, and real estate. And another thing to take note of here is that you see the policy loans. So policy loans represent an asset of the insurance company. They're literally investing in you, the policy owner, when they give you a policy loan. So when you take a policy loan, you're not taking your money out and then paying yourself back. You're literally getting a loan from the insurance company with your cash value serving as collateral. And the insurance company is intending to earn interest from you. So you're an investment to them. And that's what allows for the double play to occur, because your cash value never leaves the policy and continues to earn dividends every year. Meanwhile, you've got access to a loan secured by the cash value that you can use for investing in real estate. So that's the whole premise of the double play right there. So, all right, before I move to the next slide, let's just take note of the debt ratio in here, or the bond ratio. You see that it's about 53.5% bonds with 12.2% in mortgage notes, and the rest spread across other assets. Now, this graph is for a company that focuses almost, I don't want to say exclusively, they do offer whole life, but they're primarily known as an IUL company. So this is Securian, and the underlying company that I utilize is Minnesota Life. And here you can see that their bond portfolio makes up about almost 3/4 of the entire invested assets, with another 13, 14, almost 14% in mortgage loans, with the balance spread across other assets. They're not offering as much detail here as MassMutual did. but they are offering a breakdown on the underlying debt notes off to the right of that. So you can see here that this overall portfolio is significantly safer and more conservative than what we just looked at before with Mass Mutual. And one of the things with an index universal life is if you know that you can earn a premium over the debt market rate of return, one thing that enables you to do is to be a little bit more conservative. You don't have to invest aggressively to try and earn as great a dividend as you can. You can back off a little bit, invest more safely, and then take that interest that you earn and use it to hedge and make it up on the hedging side. So the insurance companies have a lot of flexibility here that is enabled by the IUL interest crediting mechanism. So this is important to understand. So not every company is identical, and it's very important to take a look at the invested assets of the company that you're thinking of investing in or purchasing a policy from. So, all right, so let's move on. What is a reasonable return expectation for an indexed universal life? And again, the goal is simply to beat the debt market rate of return, i.e. to earn a premium. And I typically use about 2 to 2.5% over the Moody's corporate bond yield as that number. So moving forward, let's take a look at two things. Let's take a look at what the Moody's corporate bond yield is, and then we'll take a look at some simulated interest crediting based on that to determine what the premium would have been had everything today been in place for the last 30 years of index changes. So let's take a look at the Moody's corporate bond yield. I just pulled this off Fred yesterday, and it's showing the Moody's corporate bond yield for AAA rated corporate bonds as of September 1st. And if you look in the upper left corner, you can see that rate is 2.55%. All right, so what this is saying is essentially any new money going into the policy, whether from premium dollars or from dividend crediting, is being reinvested at about 2.55%, assuming it's going into AAA rated bonds. Now, of course, the insurance company can earn a little bit higher rate of return by investing in lower quality debt, but that also increases the risk on their portfolio from the default risk of the underlying securities. So that means that there's a lot of downward pressure on dividends right now, because if you think of a company like Mass Mutual that I just showed, who's paying a 6.2% dividend, you've got, if that's the return on their portfolio right now, but any new money going in is only getting 2.55, you can see that the returns or the dividend potential is being diluted by all the new money that's being invested, unless we assume that they're taking on a lot of risk. So, I'm not privy to those investment decisions. That's all, within the insurance company and very well protected. But it is something for you to think about. By the same token, this impacts the index universal life side too, because this is the budget that they have to spend on options. So as interest rates go down and new money going into the policy is earning less and less, they have less and less money with which to do their hedging. So you also see cap rates on index universal life coming down as well. So what does this all mean? So I've got a spreadsheet that I use to really highlight or show, more of a theoretical environment, but it gives you the moving parts, and you can make your own determinations as to its accuracy. But if we assume that insurance companies are making the Moody's corporate bond yield, that means all they have is 2.55% with which to do their hedging. Now, as we know with Index Universal Life, we have a cap and a floor, and the insurance company is literally taking the money that they have, that interest from that 2.55%, and they're using that to hedge on options and trying to capture as much movement in the market as they can get with the money that they have to spend. So, if in today's environment with all the interest crediting or interest that their reserves are earning, the caps are 8.5%. We can take a look at over the last 30 years, what would a hypothetical index universal life earned if we take today's parameters. Now, don't run wild with this and assume that this is what an index universal life is going to earn, because that's not the case. This is, we've seen caps as high as 12, 13%, and as recently as just 3, 4, 5 years ago. So these low caps are a very recent phenomenon, and we're looking at 30 years of market history here that we're comparing to, and we need to think about and be aware of what is the market going to be over the next 30 years. It's very unlikely that today's historically low interest rates are going to continue for 30 more years into the future. So we just don't know. All I can do is take a snapshot and tell you, even if the caps and interest rates stayed as low as they are right now for the next 30 years, but we apply it to the historical index changes, this is what the policy would have had or performed at. So this is kind of a worst case. I'd like to think it's a worst case scenario. But again, take it with a grain of salt, because it's all hypothetical based on past performance. It's not indicative of future performance. So what I have here is 31 years of the changes in the market index from 1990 through 2020. And the column labeled S&P 500 or SP 500 is showing you the year-to-year change in the index. Again, no dividends, just the change in the index, because that's how the options work. So to the right of that, I have IUL look back. So in the very upper left corner, I've got two values. 8.5% represents the current cap on Minnesota Life's IUL for the S&P 500 one-year point-to-point strategy, with a floor of 0. So essentially, we can calculate what a hypothetical index universal life would have paid had the caps been 8.5% for the last 30 years. And I say paid, but it's in interest that's credited to the policy, not actually physically paid. So you can see that, like in 1990, when the market itself went down almost 6%, the IUL earned nothing, or 0% that year. Then in 1991, the market rebounded almost 16%, but the IUL would have maxed out at 8.5%. So what does that mean over a long period of time when you take all this volatility into account? So the best way to do that is to take a look at the growth of $100, because we can compare the ending value with the beginning value, or the value 10 years ago or 5 years ago, and figure out or impute what the rate would have been necessary to get from point A to point B in a nice, smooth, even fashion. And that's called an annualized return, not an average, an annualized rate of return. So down at the bottom, I've got my calculations of the annualized return. So we can take a look at the 5-year, 10-year, 15, 20, 25, and 30 years. And essentially, those are the rates of return that would have gotten you from the value 5 years ago, for example, to the present value, if you invested, like in the case of this one, 5.02% every single year, year in, year out, despite the volatility of the market. So it's interesting to note that all of the values, even with rates as low as they are today, are in the 5 to 5.5-ish%. You got 5.02 at a low, and 5.88 as a high over the 10 years. But for the most part, it looks like 5 to 5.5%. So if we go back to the Moody's corporate bond yield, and remembering that it was 2.55%, and even if the rates were 2.55%, that means all we can afford to buy is an 8.5% cap. But had we had that 8.5% cap over the last 30 years, you would have made 5 to 5.5%. So that represents a 2.5 to 3% premium over the debt market rate of return. Now, again, in the real world, we don't know what the insurance company invested at return on their reserves is, because Mass Mutual, for some reason, is able to pay a 6.2% dividend today in an environment where any new money going to the policy is only earning 2.5%. And the same is true with the IULs. If we impute from Minnesota Life's balance sheet, for example, we can estimate that they're probably earning a little bit less on their reserves because they're investing in a little bit safer securities. So they have a little bit less money with which to do their hedging. So all of this is, again, to give you an idea of what a reasonable return expectation is. And again, it just simply boils down to the insurance company's objective of earning a premium over the debt market rate of return. They're not trying to match the performance on an index. Doesn't matter that they're not including the dividends. The goal is simply to earn a premium over what they would have paid had they simply taken the gain and paid it as a dividend. So, to summarize, I'm going to just sound like a broken record here. The goal of an IUL is simply to earn a premium over the debt market rate of return. IUL returns are only linked to the performance of an index. They are not trying to match the performance of the index. So that's all I've got. If you're hungry for more information, I highly recommend going out to Facebook and joining my Double Play group. So it's a community on Facebook of people who are doing the double play, who are thinking about the double play, and quite honestly, I've got a lot of people who don't even have policies from me that are members of that community. So it's a great place to go to ask your questions if you are not ready to talk to a life insurance agent yet. In addition, you've got my website, innovativeretirementstrategies.com. And there you can find links to all of these YouTube videos. In addition, I do a monthly webinar, and I post the recordings there. So you've got the availability of much more content than what I've got here on YouTube. I'm quite lagging quite a bit there. And you've also got written versions. So I turn all of my outlines for these videos and blog posts, webinars, into a blog post on my website. So you can take your pick of written information or video information, whatever you respond to best. But if you find this content valuable, please like and subscribe to my channel so that you're notified whenever I come out with new content. Otherwise, I look forward to seeing you in the next video.